Hello, fellow Rebel Capitalists. Hope you're well. I'll tell you what's not doing well, and that's the United States budget deficit. I can assure you of that. In fact, it is getting absolutely out of hand. In fact, by some measures, it's worse now than it was even back during the cerveza sickness. So let's go right over to Zero Hedge and check out exactly what's going on with the deficit and see what they've got it calculated for 2 months, the first 2 months of the fiscal 2025. It gets a little weird because they don't follow the calendar dates there, but you guys will get it as we go through the article. So let's go. And then obviously at the end of this video, I want to try to ask the question, what does this mean for the economy? That's the real important question here. What does this mean for the average Joe and Jane? So first, let's go over to Zero Hedge, and we've got government spending shock. U.S. budget deficit soars in worst start to the year on record, or the best start if you think the budget deficit is good. I guess at the end of the day, it all depends on your vantage point, right? So what they're doing right here, long story short, is they're looking at the month of November and October. I guess those technically are the first 2 months of the fiscal 2025, just the way it's kind of measured. I know looking at the calendar is a little bit weird there, but bottom line, we're just looking at the months of October, November for calendar year 2024, and then comparing that October, November to 2023, 2022, and during the cerveza sickness. And when I showed that initial chart, this is what they're doing. That's why we can say that, if this is accurate, this exceeds 2020 by a staggering amount. It's not just a rounding error here. In 2020, November, October, we're looking at a budget deficit around, call it 400 million. We use this for the thumbnail, a little over 400 million. And now we've got over 600. Did I say million? Excuse me, billion in 2020. So this is during the cerveza sickness. This is during STEMIs. This is during the CARES Act. This is during the time frame when the total debt, I believe in 2020, went up by about 5 trillion, right around there. It's weird because the deficit, they'll say, was only 3.5 trillion only, but then somehow the debt will go up by like 5 trillion, will go up by even more. I'm not sure how that actually works, but the bottom line is apples to apples comparison here. We are way higher in October, November of this year than we were even back during the cerveza sickness, which is saying a lot. I wish this would go back to 2008, 2009, but I think even if it did, we wouldn't even be remotely close to where we were in 2020, let alone where we are right now in 2024. Let's get back to the article. On a trailing 6-month moving average to smooth out outliers, the spending hit 586 billion, effectively at an all-time high, with just record spending spree during cerveza pushing government spending higher. So this is just smoothing it out a bit. So where's the money being spent? I mean, I wish we could, there we go. We can see, and obviously there's two parts of this equation, right? It's not just spending, but it's also the amount of tax revenue that's coming in. So part of the deficit exploding in October, November is because spending actually went up, but part of it is because tax receipts went down. Obviously, tax receipts are going to skyrocket now that Fartcoin is over 500 million market cap. In fact, Josh, while I'm going over this article, why don't you pull up the market cap of Fartcoin? We could be over 600 million right now. So I hope you guys loaded up the other day.
Well, I also see Brando in the chat. So there's a chance Brando's now super rich from that one.
Did Brando buy Fartcoin?
I don't know. I haven't asked, but I wouldn't be surprised.
I'm sure you did. Okay. But getting, get- getting back to this here, we've got the left-hand side of the equation, and these are tax revenues declining slightly. I don't know how much they declined by. I'm guessing this yellow is indicating the decline. That would make a lot of sense, wouldn't it? So based on the same time frame last year. But then the question becomes why? I mean, why on earth, joking aside, why on earth has the total receipts declined to the degree to which it has, with stock markets being at all-time highs? Because usually that's kind of asset price. You know what? It could have a lot to do with the fact that houses just aren't selling. I'd have to think about that one, but just kind of improving here. Yeah, because think about that. If you've got, let's just take it to an extreme to keep things simple. If you've got 10 houses being sold in a year, and the government is going to make X on that for capital gains, assuming home prices are at all-time highs. If you only have one house sell, they're making X minus a big number, right? So let's just say with 10 homes being sold, they're making $10 of tax revenue. If only one house is sold, even though prices are still going higher, then that tax revenue goes down to $1. And so that could be what we're seeing here, or maybe less turnover in stocks. I think that's what it has to be. It's got to be less turnover, even though asset prices are going higher and higher and higher. It's fewer people are selling, therefore fewer people have a taxable event. That would be my first guess. Now, I'm not saying that's what's going on here, but just thinking out loud.
Well,
okay,
so I do have a real-time update on ARtCoin.
All right, drum roll.
We're almost at 700 million. We're up 20% on the day.
Come on.
Yeah, it's at right now 676 million.
So Brando's getting rich.
Brando said he's all in.
Are you pulling up the market cap?
I have it up.
Oh, it's up to 68 cents.
It's crushing it. This looks like a great bullish pattern too. If you're planning on investing for the long term.
Investing.
Yeah.
So where's I'm trying to see the market cap. Market cap. Oh yeah, you're 607.
It's up 20% today. Just crushing it. Probably from your video yesterday.
Yeah. I'm contributing to the debauchery here. Oh, geez. Hopefully not. Well, I mean, next stop, $1 billion, right?
Yeah. Yeah, I guess so.
And when's it going to catch up with gold? That'll be.
When is Fartcoin the new reserve currency?
Yeah, well, pretty soon, I'll bet, for sure. Anyway, okay. Let's get back. I can only take that nonsense for so long. So let's get back to Zero Hedge. There we go. All right. So we've got Social Security, Medicare, health, net interest, national defense. The issue, when you talk about Doge with most people, the pushback you'll receive, even within the libertarian space, the Austrian space, Sound Money, or just the talking heads on CNBC, is there's not much they can cut. Because are you going to cut Social Security? No. Are you going to cut Medicare? No. Are you going to cut health benefits? No. Net interest? Obviously can't cut that. National defense? Maybe there's some wiggle room there. Probably not much. Income, you're going to cut welfare? Maybe slightly. Housing credits? Maybe slightly. Veterans, you're going to cut those? No. Education? Probably not. So you don't have a lot of room to cut. That this is true. But I think that misses the point. I think that totally misses the point. As if the deficit in and of itself or the United States debt is the problem. Like if we could just get the debt down to, X, let's just say 60% of GDP, then, oh my gosh, then all our problems are solved and we don't have to worry about foreigners not buying our debt. That argument, I don't think holds any weight. Let me show you what I'm referring to, because it assumes that the major driver of yields is supply, or that's one of the major drivers, right? That we have more and more this deluge of supply of treasuries, and at some point the market isn't just going to buy it forever, and therefore yields are going to go up, and therefore we've got to get this spending under control so it's sustainable, right? And again, I don't think I don't see any evidence for that. Let me show you what I'm talking about. Now, it's not to say that the government spending is good. No. The government spending is the problem. The government spending is the problem because it distorts the economy. And we're going to get into how that feeds into the standard of living for the average Joe and Jane in just a moment. But we need to focus on what the real problem is here. The real problem isn't that foreigners aren't going to buy our debt and therefore the interest rates are going to explode because we have this additional supply coming on because the deficits are exploding. Let me show you what I'm referring to. So first of all, here is the total public debt. So this is obviously a proxy for the supply of outstanding treasuries, right? So we go back to 1980, let's say, we're at 800 billion. 800 billion. Now we're at 35 trillion. Big difference, right? But yet, what have 10-year treasury rates done? They've gone down. They've gone up slightly as of late, but the Fed took the Fed funds rate up to 5.25%. And I'd like to remind you that currently the 10-year treasury, although it's up, is trading below Fed funds. So I don't know how on earth you can say that, oh, well, there's no demand for treasuries. Now you say, oh, well, they're limiting the supply at the long end of the curve because they're issuing all these bills. Okay, well, then how but then same thing, right? How has the market been able to absorb those bills? And by the way, if it was all about supply, then why on earth did interest rates go up when the Fed did QE 1, 2, and 3, right? Taking supply offline. So what you do see here, as far as a strong correlation, is interest rates at the long end of the curve moving, not so much with supply, but moving with growth and inflation expectations. Right? Let me give you another just kind of tidbit here, looking at the supply of treasuries. So I think this is really a cool chart. This is the 10-year treasury. I don't know if we had something similar, a 10-year bond, let's say, for the government, going all the way back to 1790. 1790. Love charts like this. But I want to focus on 1880 to 1900 because I've done the numbers there and I've researched that so much that I know we had consumer price deflation, not just disinflation, but we had deflation, right? So let's also remember that the amount of supply of treasuries was very, very low. You say, oh, George, well, you can't compare that today. Yeah, you can. Yeah, you can. Because you just can compare the government spending as a percentage of GDP, right? So back then, we had government spending at 5% of GDP. Today, roughly, call it 50%. Okay, so we'd have way more supply. Way more supply relative to GDP today than we would have back then, right? But yet, what happened? We see that interest rates went down from 1880 to 1900. Why? It's falling growth and inflation expectations, right? We had deflation. And nominal GDP was not, 10%. Now, I would take nominal at 4% with a 2% deflation all day long, right? But the bottom line here is that it's pretty much following growth and inflation expectations, even though the supply relative to GDP was minuscule compared to what it is today, right? And I'd like to remind you that rates back in, let's just say 1900, you're looking at 30 right around 3.5, something like that. I mean, at 1880, we're right below 4. Today, where are we? 4.3. So I just, I know that this is a very contrarian view within the space, but I got to call a spade, and I just don't see any evidence whatsoever for supply mattering. I wish it would, because then it would constrain government spending. But unfortunately, I don't think we can look to the bond vigilantes to constrain government spending because there's just too much demand for treasuries. Why? Because they're pocketing a spread. So they don't care about supply and they don't care about inflation in the United States. I'm talking about Eurodollar banks, but we'll save that for a separate video. I just wanted to give you this as just kind of the cliff notes and just some examples of why I just don't see any argument whatsoever for supply impacting treasury yields. All about growth and inflation expectations. All right, so let's get back to zero hedge. And we see just more charts reflecting the exact same thing, that deficits are just blowing up. So here is where, again, I don't, the long-term chart of government spending shows we are all what we all know. Doge or no Doge, there is no stopping this train. They're borrowing obviously from Lynn right there. Not about the Doge, but that's her line here. There's no stopping this train, and she's right. Obviously, there's nothing that's going to stop the United States debt. It doesn't mean that the yields are going to blow up. It doesn't mean that the Fed's going to have to buy bonds. It doesn't mean any of that stuff. It just means that that's going to be more and more economic distortions, unfortunately, that we have to deal with. Now, I think Doge, even if it was able to stop the deficits where they are, not decrease the deficits, but just stop them, for heaven's sakes, I think that would be a big win. And what I think would be an even bigger win, deficits aside, is if they're able to reduce regulation. Now, this is a problem that I see, or at least a mistake that I see people making. In my view, it's a mistake all the time, where they associate they conflate the two. Reduction of regulation with a reduction of deficits. I think those are mutually exclusive, or they can be, right? I can see a world. I mean, just think about this. Let's say that you didn't eliminate the EPA, but you just told them that they can't do anything. Okay, well, you still have to pay those employees, right? But they can't do anything. Therefore, they can't cause any problems. They can't hamstring the private sector to the degree to which they were. Well, to me, that's a big win. Now, we didn't decrease the deficit. We didn't decrease the spending, but we got rid of the rules and regulation, which allows the private sector to grow at a faster pace. You see, when we look at government spending as a percentage of GDP, it's not just the government spending. It's also the GDP, right? So let me give you another example here. We're going to go over to this chart that Josh sent me. So look at this. 22% of renters are spending all their income directly on rent. 22% are spending 100% of their paycheck on rent. Therefore, to buy food, to pay utilities, etc., they're either having to borrow the money, or someone's having to give the money to them, or they're having to draw down from savings. That's not good, obviously. So they say 22% of renters are spending their entire income, I guess, from their first job on rent, while another 20% are working a second job to afford it. I mean, this is Uber, right? This is the gig economy. So here's the questionnaire. Which of the following actions have you taken, if any, to help afford rent? All of my regular income goes directly to rent, 22%. Worked a second job, like they said, 20. Worked a job I hated, 19. Received assistance from the government, 18. Cash gift from family. Had previously lived with family. Pulled money out of retirement. Contributed less to retirement. Received assistance from nonprofit. Sold stocks. Inheritance. sold crypto. How do you fix this? Right? How do you fix this? Well, you say, George, we could bring down rent prices. That's probably not going to happen. Right? I talk about disinflation, and even if we have a recession, you might have a bit of deflation, but you're not going to have a lot. You're not going to bring rent prices down 50% from a high water mark. It's just not the way prices work. You know, we can have a flatlining of prices where they're not going up, 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 up. But just because we have a flat line doesn't mean they're going back to where they were in 2015 or 2019, right? So that's probably not going to happen. In fact, I would peg that at 99%, that rent prices aren't going to go down substantially, at least to a point where, you know, a significant percentage of people aren't having to allocate 100% of their paycheck, or at least their first paycheck, to put a roof over their head. But fortunately, there's another part of the equation, right? It's not just rents, it's incomes. It's incomes. So let's think through the deficit, right? If we are able to decrease the deficit, just that alone, right? How does that help these people pay rent? Probably doesn't, does it? It's not going to bring down the rent cost. But if we are to bring down regulation, if we're able to at least decrease, even if you don't mess with the deficit, I mean, I think it'd be great, right? I'm all for lowering the deficit. But I'm saying that let's place our focus where it needs to be to help the vast majority of Americans out there that are actually suffering. And the way you do that isn't just, oh, well, let's get the debt to GDP down. Therefore, we don't have interest rates go up at the long end of the curve because of all the supply. That's not even an issue, right? That's taking our eye off the ball. Where we really need to focus, and let's not sit here and just shrug our shoulders and say, well, I guess we might as well not even do Doge, because why should we do Doge when they're not going to be able to reduce government spending? That, again, that totally misses the point. We need to do Doge to get rid of the rules and regulations, the bureaucracy, the red tape. And if at the same time you reduce spending, fantastic. But let's keep our eye on the prize, for heaven's sakes. Because when we're looking at these people that are really suffering in the real economy, and I'm sure you know a lot of them, they're not going to improve their lot in life by just praying that prices are going to go back down to where they were in 2010. It's likely not going to happen. Maybe asset prices, but not the price of health insurance, not the price of most rents, food, energy, etc. Where we're really going to help out the vast majority of Americans is if we improve their incomes, the income side of the P&L. That's where we really move the needle. So my point here in going over this is, let's not get so hyper-focused on the budget deficit in terms of interest rates. Let's get hyper-focused on reducing rules, regulations, red tape, bureaucracy, so the free market can create more and more goods and services, create an economic expansion that allows those small, mid-sized businesses and large corporations to pay their employees more and more and more and more, that allows them to take less and less of their paycheck and allocate it to putting a roof over their head, or food on the table, or just basic needs, increases their disposable income, right? This is how we do it. And oh, by the way, if you want to argue that we can lower prices, I'm all for that. I'm not saying there's a 0% probability, but I can assure you the only way that we're going to lower prices in a healthy way is if you have the private sector doing what? Producing more goods and services. And therefore, you increase aggregate demand while you bring down prices. Now, that would be the ultimate. I think it's a low probability, but that would be the ultimate. But how do you get there? Right? Do you get there just by reducing the deficit? No. You get there by reducing the rules and regulations. That's the most important part. That's what's going to facilitate growth in the private sector. That's what's going to help out these people struggling to pay rent. All right, guys, enjoy the rest of your afternoon. As always, make sure you are standing up for freedom, liberty, free market, capitalism. We'll see you in the next video.